Hello, and welcome back to Financially Speaking. My name is Logan Waller from Bushka Wealth Management and Bushka Retirement Solutions. If you'd like more information about what you hear today during our show, give us a call at 715-355-4445 or visit us on our website, retirewithbushka.com. And while at our website, click on the radio page and you can check out some of our past shows and subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. As we jump in here in today's show, whether you're planning for retirement, fine-tuning your investment strategy, or simply trying to stay ahead in a changing financial world, today's conversations offer some clarity, perspective, and practical guidance you can use. But before we jump into today's discussion, I'm excited to introduce our guest, Keith Gangl. He is a senior portfolio manager with Gradient Investments. And joining me to my right here is one of our other advisors, wealth advisors here, Ryan Pekka. Ryan, how you doing today?
I'm doing well.
Long time no see. We had a good drive this morning.
Yep.
Well, as we go through this episode here today, all three of us are going to have the pleasure of recording here in person with Keith.
It's great.
The man,
love
the myth,
seeing
the
you
legend.
guys. No, man, I love that too. We better record that and send that back out.
There we go.
Just trying to get you a raise.
This is going to be a good show, guys.
I will.
Of course.
All right, let's get things rolling though, Keith. So first question, what downside protection strategies are you recommending right now? Are we looking at hedging, diversification, alternatives, kind of a blend of those?
A little bit of everything that you mentioned. I mean, first of all, working with your team at Bushka is fantastic because you guys do a great job working with your clients. You have diversification. Again, there's always something hot in the market. You're not chasing performance. You want to have a well-diversified plan. You do a good job. Whoever comes into your office, you customize plans. You look at their risk tolerance. You look at their objective, and you set a plan. That's the first step. When you're looking at investments, is have that good diversified plan up front. That's one thing you'll hear. When we're talking either this show or when we talk in the past, a lot of things we talk about is diversification is key, right? Mm-hmm. You don't want to put all your eggs in one basket. You don't want to sink or swim with one investment strategy. So you want to diversify across different things. Sometimes that means that you're not always in the best thing as well because you're waiting for that performance of the other thing to turn around. So again, that's diversification's key. And there's, the market's been, when I talk about give these presentations, I always like to set the table of kind of what the markets have done recently. And if you look at the last, and when I'm referring to the market, I'm referring to the S&P 500. So when you hear people on TV or media or radio or podcast, generally speaking, when they're talking about the markets, they're referring to the S&P 500, right? If you guys remember back in 2023, markets were fantastic, up 26%. 24 followed it up with 25%. That's a massive back-to-back year, which doesn't happen very often. And expectations for this year, kind of that we had for the more normalized year, that 8 to 10, maybe 12%. And markets have done really well. We're up 15%. So the markets have done well. And again, so now it's okay. So the markets have done, a lot well last 2 3/4 of a year. Now what? And how do we protect ourselves? Kind of how to hedge and some different strategies we can implement it within our overall plan allocation and within our portfolios. So you guys do a good job of mixing and matching portfolios, right? You're gonna have some safe money, some green money, and versus some of the money in the market are at risk. And some of the other portfolios that we have, there's like buffered portfolios, which allow you to participate on the upside, but allow you to have some level of protection on the downside. I think that's a great solution for your clients, and you guys are using those as well. So that's something that, every month we at Gradient, we come out with, a menu of 5 to 7 different offerings. Some have, buffers of 100%, which means you're fully protected. Some have buffers of 30%. Some are at 15. Some are dual directional. There's different, variety of menus. And within that, you can diversify as well, right? I want some protection, and maybe you're nervous about the market, but you still want some participation. So maybe a 30% buffer is a solution that may fit well with your clients. So those are some of the things we're looking at as well. And so the other things we'd look at is within our portfolios, if we feel the portfolio's had a nice move, we may start selling off some of our winners and kind of buying some of the stuff that is a little more defensive to kind of protect you on that downside. Again, diversification's key.
Yeah, and one thing I say to a lot of clients, I don't know if you do, Ryan, is let's not invest based on headlines. Let's not chase what the headlines are saying or doing or anything like that, and making sure we're looking at that full scope of what their situation is.
Yeah, it's easy to fall in that trap of chasing that shiny object. And we did a thing the other day, and we looked at a study from JP Morgan that looked at the performance of an average investor versus someone working with an advisor, and usually working with advisors quite a bit better, right? Because you don't do exactly what you said. You don't chase that hot performance. And usually what happens to individual investors, if you're doing it on yourself, oh, the markets are up 25. I got to get more of this and I got to get these high stocks. And what ends up happening? They buy at the exact wrong time. Market sells off. What do you guys think happens when the market sells off? Do you think they're buy and hold or they're panicking? They're probably panicking. That's where, again, working with you at Bushka, you guys like, no, this is the plan. Stick to it. We're planning on, 3, 5, 10 years down the road. We're not looking at tomorrow. And yeah, we don't want to be chasing these, shiny objects. It's like if it fits well in the overall plan for diversification purposes, yeah, let's add a little bit. But you allocate it appropriately for that level of risk that the client is willing to take.
Yeah, and it's a good segue into really what we're getting a lot of questions on, and even seeing it on the news is just gold and precious metals. So can you elaborate or explain why gold and other precious metals have been outperforming, and is it kind of too late to get into the game? Are we chasing something that's already happened?
That's a great question. I'll try to get my crystal ball out here on this one. But gold this year is actually up 50%. Think about that, guys. It's like, last year the markets are 26, 25. Those are big years, but for, a more of a commodity kind of store of value, a part of the market up 50%. Even this year, the markets are up roughly 15%. International markets, which you guys allocate to, the phenomenal decision there. They're up 25%. Again, these are rough numbers. It depends on where you're at in the markets, but gold is 50%. And it's like, okay, why is that? And there's several different reasons. We had, we've talked tariffs in the past with you guys. That could be a reason that people are fearful. The dollar's weakening a little bit. It's a little bit of a fear trade. It's a little bit of an inflation head. So it's checking a lot of boxes right now. But again, I've been doing this for 30 years, and to see any kind of asset class, especially gold, be up 50% in 9 months, it's pretty amazing. So I would be a little careful on, I think it's still got a place for an overall allocation, in a client's plan, but just be careful, because there's periods, if you look at gold throughout history, you have these massive moves, but then it kind of goes sideways to down for the next decade. So you just want to make sure that we're not in that period. And do I know if it's ending? No, I don't. There's still a lot of economic turmoil. What's happening with the dollar? You got Bitcoin, things like that are kind of helping propel it a little bit. I think those are all still in place. That's why I don't see gold collapsing either on the other side of things. So it's at, it's over $4,000 an ounce. That's a pretty big move at 50%. So it's something that we're getting a lot of calls on. And there's a lot of there's no one. It'd be nice if there was one reason you could point to and say, hey, this is what's driving gold, and now that thesis for that, whatever the thesis was, is going away. Then you would want to stay away from it. But there's a lot of things going on, a lot of concerns, and I can see why people are kind of flocking to gold as, a store of value, fear trade a little bit, and inflation. And again, I've been doing this for 30 years, and historically, usually when you hear people pitching gold, it was people like working at pawn shops and things like that, right? So it's becoming a lot more mainstream. Maybe it's a little bit, AI, Bitcoin, that kind of stuff is just another. I think it's a separate asset class. So to the theme of diversification, it's just another way of diversifying, because it's a non-correlated asset as well. And the other thing I didn't mention is you're seeing a lot of foreign, treasury governments buying gold, which is, it's gold is supply and demand, right? There's only so much supply and demand out there in basic economics, that there's a lot more demand for it, which there's been by foreign governments. And then you don't even talk about the jewelry needs, and India and jewelry and things like that. So there's certainly a lot of tailwinds I don't see going away anytime soon.
Sure. Do you have any input on other precious metals? I think gold is kind of the one that grabs those headlines, but when I look at it, I think there's opportunities in silver and some of all these other ones that have more industrial uses as well.
Yeah, I think the industrial ones that we have a precious metals portfolio that we, just like you said, it's gold, it's silver, it's palladium, it's platinum. The ones that have a little bit more of that industrial use, I like those a little bit better. They've had some big moves too, though. Like palladium's had some big moves. Platinum, maybe not as much yet, but those have industrial application. That's what I like. And just in full disclosure of my position on gold historically, I'm more in the Warren Buffett camp. If you guys ever heard of Warren Buffett, right?
I think I've heard of him.
Yeah, he prefers to generally invest in U.S. companies, right? Because they produce cash flow and they grow earnings, and that's something gold doesn't do, right? Gold is all these fundamental drivers that we just talked about, but it certainly doesn't do that. So if you're looking for, a company that's going to grow their earnings or kick off a dividend or have cash flow. That's not gold. It's a store of value. It's a scarcity product, things like that. So I still, not that there's not a place for it. I'm just not I wouldn't want to have 100% of my portfolio allocated to gold. This year would have been a great decision at 50%. Would have been nice. But again, all your eggs in one basket, I wouldn't do that. But there's certainly, I do like that aspect you brought up about having more industrial applications, because that gives you that little bit of a driver of, if the economy is growing, if we need the demand for these products, they should do exceptionally well.
Yeah. I guess, well, we're talking about alternatives and kind of those other assets that we use more protectionally, I should say. If the market pulls back significantly, what strategies do you see recommending to mitigate some of those losses?
Yeah, so one of the things that you can have, we always like to call it dry powder. One of the things that you can have at points in the stage where markets get extended or had these couple massive years of performance in a row is you could keep a little dry powder or have money into kind of like that savings vehicle, your money markets, your a stable value portfolio, kind of those money market kind of things. So they don't earn a lot of interest, but even with rates right now, you're still getting 3.5%, 4% on some of these CDs, money market stuff I see, right? And it's just the things that are out there that give you a little income, not a ton when the markets are up and gold's up 50% compared to a couple percent, right? That's not, but what it does is if the markets do have a downturn, you have that little bit of extra money or cash per se, it's like a cash equivalent. Then you can put that as a buying opportunity, and then you won't have to sell something that's down to buy something else that's down. You'll have that dry powder and stuff that's sitting on the sideline. So that's one thing now with, overall allocations, when you guys are making decisions, you have your at-risk money, your 60-40 client, and maybe it's going to be 60-38-2 or something like that, where that 2 is maybe kind of that safety bucket. Okay, well, we maybe need a little income for, maybe you got a house expense, a boat, something that's coming up, or we're going to use that money if the markets kind of pull back a little bit. That's the kind of decision. And the other thing that we can do within our portfolios that I manage, is the ones that we look at here, is you can get a little more defensive. That means maybe sell some of these names that have done really well. And obviously technology is one of the sectors that perform really well. Sell some of those names and buy some more defensive staples, like names that if the market does turn down a little bit, everybody still needs to go buy their state, whether it's, your Cokes, your Pepsis, that kind of products.
Still need healthcare, still need
exact
electricity and heat the house and all that.
Yeah, your utilities is a perfect example. That's traditionally a very defensive thing if you think economy. Now, utilities this year they've been pretty good due to the AI derivative play that we've talked about in the past, where it's the power generation. Utilities have done really, really well because of the demand on the grid. And that's another whole discussion. We probably have 3 or 4 shows on with just the demand, where's that going to come from is now AI driving costs for, homeowners just on, the second derivative, now that causing their expenses to go up. So there's a lot of things to think about in the pack there.
Yeah, and that's where we've already said here in the part of the show is it's important to sit down with a financial services professional, because we're keeping up with the changes in the market. We're keeping up with policy changes or law changes, and everyone's situation is different. A lot of the workers are out there in a 401k and all they know is mutual funds.
Yeah.
They know stocks and bonds. They don't know that there's other alternatives and other strategies within that investment strategy or game plan. So one of the things that can come up sometimes from the strategy side is tax loss harvesting.
Yeah.
Fun topic there. We could probably have another show on, but could you just, for our listeners out there, just explain a little bit of what tax loss harvesting is and if there's any current opportunities for it?
Yeah. So tax loss harvesting is basically when you sell a stock or security or some investment that's down from your original cost basis. So for whatever reason, it's a poor performing stock or out of favor, say it's down 5-10%. What we call tax loss harvesting is then you can sell that stock or ETF or whatever it may be and replace it with something that's similar to it. And it's just like you have the same kind of risk profile. You're not changing that for a client, but then that allows you to say you bought something at, like, for example, we rolled out one of our tax advantage portfolios this year. Started out this year, looks like the market is doing well. All of a sudden we came to Liberation Day, which we found out was also Kaylee's birthday.
Yep, we'll never forget
that.
April 2nd.
April 2nd.
We won't say the year.
Oh yeah, good point. Let's keep that a secret. So the market sold off, and what we did in one of the portfolios is then markets were selling off 5, 10, 15, 20%. Every week we went through every account that we had every Monday and say, okay, is this position down 5%? If it was, we sold it and buy a similar position. And so what that did is accumulate losses. And now that bucket, they have a bucket of losses that they can use against any gains at year end. And now what ended up, we didn't know this was going to happen, but the market, setting all-time high. So you had that nice dip of 20%. You captured a bunch of tax loss harvesting. So now you have this loss bucket. And again, if we don't sell any of those securities in that portfolio, that's fine. There'll be no capital gains ramifications within that portfolio at year end. But maybe you have some other investments elsewhere or something else. You can use that tax loss harvesting against that. So it offsets some of that. So it helps lower your overall tax burden. So it's a great technique, and it's worked wonderful this year. And again, we'll have pullbacks again, where it depends on where your entry point is, and if your cost is low, or if your cost is higher than where this security or ETF is. That's an opportunity to tax loss harvesting. And again, something you guys do well with, looking at your clients and removing money and how does it impact their taxes and after tax return. How important. Like I said, I don't think I've seen anybody do as well as you guys looking at the after tax returns of clients, and consider that when making investment decisions. Right? There's always that part where let's move money, but then you forget about, well, that's going to cause some kind of tax implications, right? Well, let's figure out exactly what needs to happen there. And you guys are fantastic working with diversification. Logan, you mentioned it, every client's different.
Mhm.
You're not a cookie cutter solution. It's like you sit down and listen to their needs and wants and kind of figure out where their risk tolerance is and build a plan around that, a well-diversified plan.
Yeah. I mean, it's a great strategy, and it's something that we utilize, especially in those non-qualified accounts
sure.
where those make, where it actually makes a difference.
Yep.
When you think of a traditional IRA or Roth, it's not really an advantage there to that, but in those non-qualified, it's important. A lot of people don't think about those things when they're making their own investments either. It's just not
Especially in retirement.
not a well-known tactic, so to speak, I would say, for your retail investor. So it's great that we work with professionals like you that help us out with that, and then keep that in mind too. It just helps the client in the long run.
Yeah, and I'm glad you pointed out it's the non-qualified money, right, versus the qualified, because that's really where it's going to have the most impact on the tax loss harvesting. Is for the qualified money, your 401ks, your IRAs, less impactful than you guys. Again, working with you is fantastic, just because you consider that, and that's just, again, what you keep at the end of the day for your clients is very important to them.
Yes. So we've talked about some protectionary tactics, tax loss harvesting tactics, things like that. When we talk about it, they're all revolving around risks and things that we are trying to protect ourselves from. But when we're talking about it, what are some of those risks, the top 2 or 3 risks you see for investors right now that you want to kind of talk about?
Yeah, this is another good question. It's taking a step back from before we jump into that, is generally speaking, there's several things that drive the overall stock market forward. But if I had to pick one thing, it's usually earnings growth of the companies within the, so I think earnings growth drives ultimately the stock market over long periods of time. There could be some short-term dislocation. So my number one risk, that being said, would be earnings. So right now we're right in front of earnings season, or getting into it. Earnings seasons, happens 4 times a year. All the companies that are public report their quarterly earnings, and they'll talk about the success and failures of their products, their services, whether tariffs are impacting them, whether some government mandates coming down that's impacting them, whether things are getting better or getting worse. That's a good scorecard for how we look at. That's a very busy time for us as portfolio managers to evaluate the overall economy, what's happening within the economy, and hearing from CEOs directly on these calls saying XYZ is happening to my line of business because of tariffs. Maybe tariffs aren't an issue. So that's a very important thing. So I think that's number one overall risk, is if earnings actually disappoint. Just so you know the backdrop, this year the earnings forecast for the S&P 500 is for a 10% growth rate. Historically, if you're in that 6 to 7, that's very healthy. So 10% is good. And I think that's what's driven the market, right? Investors are looking what's going to happen forward, kind of where the pucket's going to, not where it was. So going into this year, the forecast was for 10 or 13%, excuse me. We're now at 10. So we said it, at Gradient, we're like, that's 13 is too aggressive. We think more like 9, maybe 10. Actually, estimates did come down to 9%, intra year. Now earnings out of Q2 are better than expected. So now they're actually about 10.5% for the full year. So again, that's reacceleration. That's a good thing for the stock market. That's a good backdrop. Now, as we wrap up this quarter, we'll hear Q3 results. companies will guide for Q4, so I'll give us some insight to next year. And some may talk about 2026. It might be a little early, but so the consensus right now is kind of all the Wall Street gurus out there. 13% is the number for next year. That's a big number again. I think that number is too high, but I think it could play out like this year. If it does 10, that's still a nice backdrop for stocks. So that's the number one risk. I think the number two risk would be inflation. We've talked about in the past, I'm sure you guys, with the Fed, Jerome Powell, the dual mandate of the Fed, they have to have, stable pricing, which is inflation, and full employment, right? That's kind of a balancing act. Right now we're, employment's starting to soften a little bit. Inflation kind of seems sticky around that 2.5%, 3%. So I think if for some reason, maybe it's tariff related, maybe it's something else that I just don't see yet, that all of a sudden inflation starts spiking, that would basically tell the Fed that they can't cut interest rates. And the market is expecting cuts. The market's expecting probably one, if not two Fed cuts, which means when I say a cut, generally the market's referring to 25 basis points. So 2 cuts would be 50 basis points. And over the next year, expecting 100 to 125 basis points, 5 cuts. If inflation spikes back up, if you remember back in 2022, we had the huge, Fed was easing policy. Inflation spiked up after COVID. Inflation at 9.1%, and Fed started raising rates. So I think that would be something that the market's not considering right now. If inflation starts, that 3 goes to 4%, I think that's a bad sign. So 4 or 5, and then the Fed's going to go from this easing cycle, which is just talked about, which the markets like, stock market generally likes less.
Sure.
It's cheaper to buy assets when they're, it's good for the consumers. We talked earlier, that's lower rates is not necessarily good for the retirees, right? Yeah. Their safe money is not worth as much. But I think that could be a certain risk. And then I would say the wild card, if I had to do a third one, would be tariffs and kind of the Supreme Court decision.
Yeah.
I've been asked before, what do you think? I don't know on that. I really don't know what could happen there, but I would say, April 2nd, Liberation Day, Kaylee's birthday, we saw the market saw pretty aggressively that on the thoughts of tariffs. But now the market's setting all-time highs. I think investors are comfortable with that. Now, if the Supreme Court comes out and says that, and again, if they come out and say overturn the ability for Trump to negotiate with tariffs, I think that puts him in a bind for he's the art of the deal kind of guy. I think that kind of hamstrings him, and I don't think he'd like that. And I do think what the administration will be creative and try to apply these tariffs elsewhere, but I think that kind of in big picture theme, that kind of hamstrings Trump a little bit to his ability to do deals. Right. So I would think investors may think that's a slight negative. So that would be no one's talking about that. And I do think if the Supreme Court overturns them, the administration finds somehow to actually add them back in. So, but it's again something to keep an eye on.
Yeah, when you say the word deals, that makes me right away think about what's kind of going on right now with our government shutdown and trying to get the two different parties to work together and all that. So when it comes to a government shutdown like we currently have, but just what are some thoughts from your 30 years of experience and seeing this go through? Like, what does it do to the market? Like, what should we expect, and what should these listeners expect?
This is a great question, and listeners should just jot a few of these points down. So the shutdown sounds horrible, right? Just like the tariff term just sounds horrible. Tariffs are a tax, so they're not great. But the shutdown seems like, oh my goodness, everything's shut down. That means no business is happening. But the government shutdown is only partial. And the also thing to put that in perspective is since 1976, we've had 22 shutdowns. So it's not like it's uncommon. Doesn't happen every year, but every few years, both sides, Republican and Democrats seem to disagree on something and push the envelope a little bit. And then typically, on average for those 22, they're 8 days in length. So very short, so we're surpassing that now. So we'll see where they end up, and who knows, they could be over tomorrow, right? It just, if they both can agree on something, but I think this one's going to be a little bit longer. The last one we had was back when Trump 1.0, that was in 2018 going into 2019. That was 35 days. So we don't always say history's, the gospel or anything, but we use it as a guide. I don't know if 35 days is right. It's going to be longer than the average of 8 days. And the other thing to keep, there's two things that I think the market's kind of overlooks or looks through the data is there's been 8 days on average. Even during the shutdown, the market ekes out a little gain. It's like 0.3% on average. Again, that's 22 periods, but it's a pretty good sample size. And the more important number I think to consider is the S&P 1 year later after the shutdown ends is up almost 13%. I think it's 12.7 on average. So if you guys know, you've been doing it long enough, it's average, depends on the years you're looking at. The S&P 500, it's 8 to 10%. So if we get a market almost up 13% after shutdown, kind of looks through. And part of the reason it looks through is A, they're short, and B is the fact that any of the employees that are federal employees are furloughed. They generally, after their 8 days or whenever this shutdown ends, they get back pay. So they're really not missing anything. Now, you go into longer ones, you used to start making, as a person not getting a check, you have to start making decisions of, okay, let's prioritize my bills, my rent, this and that. And then I have less for discretionary probably, which is not a good thing. Now, if you 8 days, you probably didn't miss a pay cycle, so not a big deal. Plus, if you did, it was maybe 1 day or 2 days, and you got your back pay, so it's really not an issue. Now, if you go 35 days longer, then it certainly could be some. I think the market longer it goes, the more nervous the market will be. So I think that's just something we got to keep an eye on.
Yeah, it changes a lot of strategies in those
It
moments
does, right?
too,
So it's like
where we're
that's why.
taking money from, what are we doing, all that.
And I assume, like, talking to you guys and what we're doing, we haven't changed a whole lot because we do think it's going to be that a little longer than normal, but it's not going to impact the overall economy. So you don't want to make investment decisions that are looking out 3 to 5 years based on a 2-week window, right?
And people are still getting Social Security, all of their major
that was the other thing I forgot to
benefits.
mention.
So it's not like this make or break for them. There are definitely things we need to be aware of, but it's not this that's changed our whole strategy.
I'm glad you pointed that out because Social Security is the number one question I wanted to lead with is people are still getting their checks. Medicare is still going. Military is still going. FFA is still going. The things that are closed are like national parks. So that's kind of a bummer. Government data, which the Fed depends on, which investors depend on. We just missed our the first report of the month on. So that's some of the stuff is, we have to keep an eye on. So, but the other thing, I'm sure you guys are happy to know, the government's open to take your taxes. They're not closing that part. So that part is, so
open?
listeners may not like that part. It's funny how that works. Some stuff can, be shut down, but oh, by the way, the register is open for you guys need to pay.
Yep, exactly. Well, we maybe have time for one more question here, and then we'll start to wrap things up here. But I guess as we end the show here, what's kind of your outlook or forecasts as we go into this fourth quarter, and then really as we move into next year?
Yeah, fun stuff. We'll get the crystal ball out here. I think it's going to kind of. There's never a normal year, but that 8 to 10%. Again, I'm not going on a big limb here. I do think the fundamentals are still in place for that normalized kind of return. So you don't want to get super defensive because of markets had a nice run. I mean, earnings are still really good. Unemployment's low. Valuations kind of stretch on the overall market. But that being said, I think fundamentals are still in place. The market's like when the Fed's cutting, that seems to be the glide path of next year. I think there's a lot of tailwinds. Now, I wouldn't expect a repeat of 23 or 24, even, so if we get that 8 to 10, I think that's a good spot to land.
Perfect. Well, before we really totally wrap up today's episode, I want to mention that our women's group is hosting an exciting event. It's called the Breaking Financial Barriers Brunch. It's coming up on October 25th. We'll have Lisa Schreiber from Gradient Investments, who will share tips on empowering women financially and give a quick market update. There will be brunch, mingling, and fun prizes, so don't miss out on that. You can registration is now open at empoweredbybushka.com. So check it out for more details.
Yeah, absolutely. And we hope today's conversation with Keith here gave you some valuable insights into the market and your financial future. Listeners can visit our website at www.retirewithbushka.com or call our office at 715-355-4445 to discuss how we can answer your questions and address your concerns about 401ks, your financial strategies, or any other part of your retirement, really. It's our goal to help you prepare for retirement you've worked so hard for.
Catch you next time.